Welcome to Common Sense Investing. My name is Cameron, and today it's a live stream, probably more of a video. I doubt there's going to be tons of participation in a live stream like this, but an easy way for me to make a video talking about stock market timing in microcap investing, right? So this is right now, this is a members only live stream. Maybe in a couple months, I open this up to the public. We'll see how it goes. But this is part of my ongoing series for newer investors, new investors to microcap stocks, where I'm talking about some of the basics and some of the concepts. So if you're an experienced investor, feel free to watch, right? Like, I am going to have a little bit of fun in this video. I am mostly pulling up slides from Ian Castle and just kind of giving my opinion, because it's amazing how very controversial, I think, in the past year is so many people thought Ian Castle was kind of like a buy and hold forever kind of stock market investor. And a lot of his posts recently, I swear, talking more about trading than investing, right? So recently he came out and said that his average hold is around 18 months for a single stock. That surprised people. And I'm going to talk about some of his posts recently, talking about, you know, the expectations for the timing of different stocks and microcaps, and giving my own opinion, and I'm just having a conversation. So I have to say in this video, do not expect me to tell you how to time the market, how to time any microcap stocks. That is not essentially the point of this video. I'm not going to talk about technical analysis or valuations or anything like that. I am simply going to talk about some of Ian's posts, giving my opinion on timing microcap stocks. Now, in saying that, not financial advice. I'm not your financial advisor. I'm really not going to give any financial advice anyway in this video. I'm just giving some opinions of some different strategies and basically replying to some X posts, right? But just in case you imply, you seem that to think that I imply that something is a good buy or not a good buy. That's not the intention of this video. I really just want to create discussion around some of these topics and talk about them because they're interesting, they're fun. This is what I like to do with microcap stocks, is just talk and learn from other people, and hopefully some people learn from me, and that's kind of how we grow the community. So if you have any questions, comments, concerns, or anything else, throw it in there, throw it in the chat, and I'll get to it at the end of this little presentation. Right here, right? It's always interesting to me. So again, a lot of people, I think, assume that Ian Castle was a buy and hold forever type investor. You read this latest post from Ian Castle saying the tough part with holding microcap winners is understanding the shelf life of execution is much shorter in micros. Management strings together 1 to 4 great quarters. Not 1 to 4 great years, not 1 to 4 great decades, right? Ian's saying 1 to 4 great quarters, and the stock gets way overextended because investors assume it will continue, and then it doesn't. 95% of the time they fall 50% plus off the highs, and that's the base rate. But we anchor ourselves in the moment to the outlier. That's the outlier is basically the 52-week highs, right? Less than 5% of winners that do keep going up. Think about this comment here, right? So this is a large microcap investor, one of the most successful microcap investors, runs his own funds, and he's basically saying that he's looking for stocks to string together 1 to 4 great quarters. They're going to go up. They're going to get overextended. He'll probably sell. They're going to drop 50% plus, and that's their new base rate. And then only 5% of those stocks are going to continue to actually succeed. This is depressing. This post is depressing, right? It's basically saying that, you know, we're trading here and we're not investing. And this really comes down to agreeing with what I've been saying for a long time, even though people were sometimes disagreeing with me. How to make money in stocks is typically where I start out with in a position. And this is more, it's not like a day trading. When I say day trading, I'm not talking about, you know, when I say trading, I'm not talking about day trading. I'm talking about, well, I'll talk about that in a minute, but basically I'm buying a stock with the intention of selling it. I'm not buying a stock with the intention of holding it. So this is where I initially start investing in a company, is very high risk, very speculative. I take it, see, this is position size here. So I take a very small position size to start. right? And I'm basically trading the stock, and maybe I am looking for that 1 to 4 great quarters and that's it. And then potentially I sell, right? And then over time with research and as I build up confidence, maybe the company does continue to succeed. And that's when I move more away from this how to make money in stocks, this basically trading position, into the 100 baggers, which is the coffee can or the long-term hold position, right? But this takes time. This takes research. This takes more and more confidence. And yes, you know, I always say that 4% of these stocks are going to be winners. Ian Castle is saying that less than 5% of these stocks are going to be winners. I completely agree. So for new investors, this is so important. Understanding microcap stocks is it's not like Amazon or Tesla or any of your other favorite microcap or mega cap stocks that you just think are going to kind of consistently go up over time, or maybe not consistently. They're going to do this and you're going to have buying opportunities, but they're such a large company, they're eventually going to be larger over time. That's not necessarily how microcap stocks work. What Ian Castle is saying here is you have to be aware of the potential of you might get something like this, you might get something like this, and then it just kind of peters out for a decade, right? This is the potential in microcap stocks, is these massive gains, but it's also the risk is what we're saying here, in that, you know, you have to be careful not anchoring to the top. And you have to understand that even the greatest microcap investors out there are potentially trading, i.e. they're looking to hold a stock for only 1 to 4 great quarters, and then get out before this 50% sell, and then try to find the 5% of winners that are going to be actually continuing to succeed. This is everything about microcap investing basically in one slide for me and one post. And we see that. It's interesting because this is an Ian Castle stock. This is Sanuwave Health. This is a newer company. So is he talking about a company like Sanuwave? Went from, you know, $28 here. It was much cheaper. It was down around $10 to $15, went all the way up to 46. Now it's down 50% off its highs. Is he talking about Sanuwave? Maybe it's a little bit early. This company, this chart is basically only going back 1 year. That's not a very long time. So maybe that's a bit too short, but we get companies like ADF Group. I mean, look at these gains here. When you look at Ian Castle's post, I mean, it does look scary in that, you know, overextended here, I would argue, right? Once it got to this point, it's corrected at this point, you know, now it's arguably cheap. But I mean, is there going to be continued success in the future for ADF Group? Are they going to be one of those 5% of companies that can recover and continue going up? It's a good question. Or whether it was just all the money to be made was right at the start with ADF Group. XPEL, this is another one here. Very famous stock, went from absolutely nothing, pennies per share, all the way up to over $100 per share here. And people made an insane amount of money in XPEL. This is Paul Andriola from Small Cap Discovery's most famous stock. But you could see here, ever since about 2021, down, tried to recover, down, consolidating. We now have a stock that went from pennies per share to over $100 per share and is now sitting at around $35 per share. What does that mean, right? All the money, most of the money was made right here from any time before COVID to basically middle of 2021. And if you bought this fantastic company, this fantastic stock in 2021, you're still down 50% plus and waiting. So it's such an important point for me. I agree and disagree with this post. It's a bit scary, and I think throughout the rest of this video, I'm going to help explain it a little bit, right? I think you have to make sure that you're changing your perception from that shorter term trader, that shorter term investor, to the longer term investing. And the difference is it's hard to do. It's easy to say, it's harder to do. Because in my opinion, you have to change your perception. It might mean changing your research from shorter term opportunity and catalysts to deeper term research into industry, product, service, competition, management, right? So many times when I get in a stock, I might not be fully researched on it. It strung together 2 really good quarters. It's trending up and management sounds bullish. I might buy, right? And I'm looking at that shorter term opportunity and catalyst to make money over the next 1 to 4 great quarters potentially, right? But that doesn't mean I'm going to keep it. That doesn't mean I believe, based on my short amount of short-term research, that it's going to be a success story forever. You don't want to get anchored to that bias that it's making me money, it's made me money, it's going to continue making me money forever. That's not necessarily the truth. So it's very hard where sometimes, especially in our winners, especially in some of our short-term winners, that we have to stand back and maybe change our research a little bit and change that research into a little bit more deeper research, right? Okay, short term, they've been very successful. Longer term, how are they going to do? And I think, again, that brings me back to the difference here where with time, I do research. Maybe I don't always move into this buy and hold forever type mentality. Maybe at this point I've made my money. I don't think the company is going to continue to grow. I don't think it's going to continue at the same pace it's been, operating at, and I sell and I may take my profits and leave, right? But it's all about doing that research, and it's all about understanding the pattern and the flow, right? Short-term gains, short-term winning stock doesn't necessarily mean long-term winning stock. There's a difference. There is a difference. All right. So I love that one. I absolutely love that one. I love this one almost as much, right? Oftentimes the best new ideas are old ideas you used to own. You already know where the skeletons are buried and what needs to change to make it investable again, and you can react quicker than others when you see those changes. This is one of those posts where I absolutely agree 100%, and it ties into the last one a little bit. Why? Because it saves research, it saves time. The risk is bias because you know these companies, right? But basically, these are the companies that we've researched. They've been short-term winners, right? They've made people money. They've done very well. But then because of this last post here, because of this post, people get out. They think the company's had the 1 to 4 great quarters. They think the company's going to not be one of those less than 5% of winners. It's going to be a failure, or it's going to stagnate. And so they try to sell and get out before the stock falls 50%. And then the stock does fall 50%, and it looks like a loser, and it might sit there for a while. But because you're putting in your time and your research, and you're looking at this company in more depth, hopefully without bias, you know it very well, and you can make the decision that I disagree with the market. You'll see me say that sometimes on social media or in my Discord, that I simply disagree with the market. This is usually because of these stocks that people think have basically run out of life. They're done, they're toast, we made our money, it's overextended, let's get out. And they end up being incorrect because of the deeper research that you do into the long term of this company. So I find that saves time. I make typically a lot of money on these types of stocks. They're easier, right? It's not learning a new story and being wrong because it's a new story to you. It's going back to some of these old stories. Matrix is one of these for me, right? You look at this. Again, back to the long-term versus short-term. If you had bought, Matrix for the long term, this is 2014 for Matrix, you bought it 24 cents. Let's say, 2015, you bought somewhere in here, 23, 24, 25 cents. In a decade, it's now at what, 36 cents? So you've made 10 pennies in 10 years. You've made 1 penny per year in this stock if you held long-term. But if you understand this company, right? If this is a story that is old to you but new to other people, you know where all the skeletons are, you know what changes it needs to make to all of a sudden make it investable again and make it attractive again to the stock market, you could try to time and predict some of these waves. And so the people that have properly and correctly traded Matrix have made an absolute fortune. Right? I mean, if you bought it here, sold it anywhere here, you made a fortune. and then years later, it's an old idea to you. You could see that it's made changes and it's potentially going to be investable again, and you bought it here again and sold it anywhere here again. You made another small fortune, right? As long as you get out and you sell. And then, of course, here, back in 2023, when all companies were devastated, if you say, well, I know this company and it's worth more than this, so I'm going to get back in, I'm going to buy some shares, and you bought down here, again, you know, wherever this company is going in the future, you have made money. Now, the real question now is getting a little bit more volatile here. What's next for Symmetrix? Some people are betting that it goes back up like this, potentially with that nice big spike. Other people are betting that it goes back to this kind of standing resting point right here. I'm not going to say what I think. You can go check it out in the Discord, right? But I mean, there's only two potential price paths for the Symmetrix to take. And again, for me, it really depends on how much research you put into this, if this is an old idea to you, and whether or not you believe in your research where this is going to go. But again, this is another example of, you know, traders basically made money in Symmetrix on these spikes, whereas long-term investors have made, you know, a dime in the past 10 years. So definitely an edge on a stock like Symmetrix to the traders. Now, the next one here is going to explain that a little bit. I've talked about trading and investing a few times. Well, here's Ian Castle to the rescue to explain it sometimes better than I can, right? When I say trading, I don't mean day trading. Get like the COVID time period out of your head. I'm not sitting here with like 6 screens up in my studio of different charts, buying a stock in the morning and selling it in the afternoon kind of thing, right? What I'm talking about is what I 100% agree with Ian Castle here, is that when you're investing, your intention with your purchases is to hold. You want to hold, right? You want this company to succeed. You want this company to succeed long term, and you hope to be holding this company for the next 10 years. Your intention is to buy and hold. That doesn't mean that you will hold. Common misconception. That doesn't mean that every stock that you're buying as a retail investor, you have to put in 1,000 hours of research and you're going to hold it for 100 years. That's not really the goal. Just that your intention is to hold. It doesn't mean that you will. Not every investable stock is necessarily a coffee can stock unless you subscribe to that method 100%. But here's the real clarity. Trading, in my opinion, right? Your intention with every purchase is to sell. That's it. I love that. I love that explanation. I love that definition. It's just your intention is to sell. Now, that doesn't mean, today, doesn't mean day trading, doesn't mean that I'm some degenerate trader that's just buying and selling stocks all day, right? It's just that I may not, for whatever reason, I may not be fully researched, but I know that this stock has momentum. Maybe I'm going to buy it with the intention to sell, but I'm going to continue to do my research on it. Maybe I'm wrong, but I set some type of time or price target where if this stock reaches this, my intention is to sell it. You see me do that quite a bit, where I'll set short time targets, where I'll say, look, this isn't my favorite company, but I can recognize they're improving. I think they're going to improve. Again, back up to that other slide for the next 1 to 4 quarters. So I'm going to buy this stock. I'm going to watch the next 1 or 2 quarters. And depending on what they do in the next 1 to 2 quarters, I intend to trade it. I intend to sell it and make money, right? Because I don't think, long term, I don't like this company, but short term, I like it. Now, what short term for me, that can be 3 weeks, 3 months, or 3 quarters. Once you get to a year, I think that's more investing, right? If you hold a stock for 12 months, I think that's definitely your intent is to hold. But if you're going 3 days, 3 weeks, 3 months, or 3 quarters, and your intention is you don't like this company, but you think it's going up, so you're going to buy it, I think that's a trade by definition to me, right? So when you see me on any live streams, on any videos, in my Discord, on Substack, wherever, and I'm talking about trading, that doesn't necessarily mean like day trading. That could be, for me, anywhere short of nine months or less, it could be trading, right? Versus investing, I'm looking at this company long term. Now, the other thing that's interesting for me in this type of definition here is that I can be wrong, right? Again, I don't have any set parameters. There's times where I could be trading. I am a huge fan of time targets. Again, what is my time target? Is it 3 days? Is it 3 weeks? Is it 3 months, 1 quarter? Is it 3 quarters, which is 9 months? Why am I buying this stock? What is my time target for this stock? What am I watching for? I might be buying it with the intention to sell. I might be buying a stock as a trade. But then it continues to execute. Like, when am I going to sell? When am I holding? Always have a plan. When am I selling? This is, if you do this over and over and over again, you experiment. This is where you build experience in microcap stocks. Some of my best returns, some of my longest term holds that I am investing in started out as trades where I had the intention to sell, and I just turned into an investor. Over time, with research, I was proven wrong. It wasn't a great short-term company and then just kind of a shitty long-term one. It was good in the short term, it was good in the long term, and I ended up holding. So you don't necessarily have to pick one or the other, right? You just have to be flexible. But understanding these concepts is important, I think, especially for new investors, because I find sometimes with new investors, there's kind of 2 common mistakes where you buy a stock and you think you're investing in it, you think you want to hold it long term, and this is the best company in the world, and then it goes down. Right? And then what do you do? Like, you just don't know what to do, because your plan was to just, for this stock to just go up forever and it's going to be a long-term hold, and now it's down 50%. And then you sell at the bottom, you miss the rebound in share price, and you basically bought at the top, you sold at the bottom, and it's just a mess and you're upset, right? You have to be careful with this type of investing philosophy, right? Most long-term investors, and I just showed you one of the most successful in Ian Castle, is talking about 1 to 4 quarters of success, and beyond that, only 5% or less of companies actually succeed. So be very careful. If you're investing in a stock right off the bat, you need to be sure that this is one of the top 5% or less of companies. The other thing, though, sometimes is people thinking trading. I know a lot of new investors come in here and talk about, they'll buy today, they'll make 20% gains, and they'll sell to lock in profits. I am absolutely a huge fan of protecting your capital. I don't want you to hold a stock and then it just drops 80% and you just hold. Like, that's not how this works. At some point, you need to have a stop loss to recognize that you're wrong and protect your capital and make sure you have money going forward if you're wrong on a stock. But at the same time, you have to be willing to hold your companies long enough so that when they go up, essentially you can capture those gains, right? And so for me, again, I keep coming back to this. This is probably one of the most important slides I've ever built, in my opinion. I've recently actually added the hold right here. I didn't have hold on this slide before. I just added this because it is so important. But basically for me, remember, I will build a thesis on a stock. This doesn't take 1,000 hours, 10,000 hours of research. I've bought a stock on as short as 1 hour of research, as long as it was recommended by somebody I trust. But again, it's position size, right? If it's a stock I haven't put a lot of research in, if it's high risk, I'll just buy a tiny little bit. But I will buy some shares, even if it's just a tiny little bit. And then over time, I now own this position. I have a reason to continue my research on it, and as inputs come in, different earnings, different news, or other things that could happen. Decibel Cannabis just had a reversed share, reversing their shares 50 to 1, right? There's all kinds of inputs. As these inputs come in, I then go and reevaluate my thesis that I started off down here with, and over time, again, I'm building time, building research. I'm not doing it all at once. I'm not putting in 10,000 hours into a company on the first day kind of thing, and then shit, it turns out to be a crappy company. I've just wasted all that time, right? I build small, I start small research, small amount of money, and then over time as a retail investor, as I evaluate those inputs, I'm putting in more time, more research, and then when I reevaluate that thesis, then I'm either buying more, I'm trimming or I'm selling or I'm holding, depending on what happens, right? And sometimes this is the hardest thing right here, is simply holding, right? So lots of times we get excited about a stock to start. We're going to buy too much, too hard, too often, too big, too much risk. And then when we get upset at a stock, we tend to sell 100%. A lot of people sell 100%. That's probably one of the riskiest parts, right? Buying contains risk. Selling contains risk. I think the least risky are typically small buys, small trims, and then sometimes it's just holding. Maybe the thesis is where it should be. You don't have enough information and it's just time to hold. So this is a fantastic description here for me with Ian Castle between trading and investing. Finally, because all of that to me is a bit scary, right? Especially as a new investor, I would be like, wait, let me summarize this for you, Cameron. Like, so you're telling me I have to do all this bloody research to invest in a stock. It's only going to be good for 1 to 4 great quarters, which is 3 months to 12 months. So I'm going to put in all this time, all this research, buy a stock. I have to be early, otherwise my time is pretty short. And if I'm wrong, 95% of the time I'm going to face a 50% drop. That's depressing. That is shitty, right? Those are terrible odds. That does not sound very appealing, right? And then only 5% of those stocks are going to go up. That starts out pretty lousy, right? And then it's like, okay, one of the best ways to avoid that is by understanding a company for a long time. But Cameron, I'm a new investor, right? I don't understand any of these stocks for a long time because I'm newer to the microcap space. So you're saying one of the best ways of avoiding these timing issues is to have these old ideas and to buy and sell and kind of get in and out of them at the right time to make money. Well, Cameron, I can't do that. That's scary as hell. And your solution, Cameron, is to basically become a trader. Is what you're saying, to protect your capital, because as a new investor, you should have the intention of potentially selling, because I don't know as a new investor that you necessarily have all the skills or experience yet to determine if a stock is 100% going to be one of those 5% or better stocks that you want to hold long term. So that's all kind of scary, I think, as a new investor. And so what is the solution to that? And I have a couple, is basically this, right? This is my solution personally, is that build experience by, buying small position and going through the exercise of researching inputs. And over time, you will become a better and better investor. The other solution, I think, for me is usually Ryan Telford, right? So how do we avoid this market timing issues that we're always talking about, especially if we're looking for those longer term returns? I always come back to this slide. You've seen me post it everywhere. It's posted on my dashboard that I post on Discord, where I do valuations for stocks, basically Y sheets, right? Talking about sales growth, profit margin growth, and multiple expansion in this little pie. But Ryan explains it very well here, in my opinion, how to avoid some of these timing issues. Is that a lot of these people in the short-term gains, in short term, a lot of people are looking for multiple expansion, right? They're looking for finding a stock that's not discovered. It gets discovered, it goes up really quickly, but it might only be worth this, right? So it was worth this amount of money. You discovered it here before the rest of the market. You invested here, but now it's up here. This is usually, in my opinion, through 1 to 4 great quarters and discovery, right? So it gets discovered by the rest of the market. This works great in the short term. 100%. Usually what drives this, although lately it's been changing because we are in a bit of a bull market, we're getting a lot of these pre-revenue stocks that are going to the moon. But normally what drives this, if you look at a company like Zoomed, right, is earnings growth. You get a company that was not profitable, now it is profitable and it's growing quickly. Oh my gosh, if you can get a company that The market thinks, not necessarily that it is long term, but the market thinks it's growing and profitable, and it can be growing and profitable for a long time. Well, this company here that's worth this but went up to here, it can continue going up, because people will make these wild projections and pay these huge, massive prices for it, because it's going to just keep going up forever, because it's got incredibly profitable, high earnings growth. Kraken Robotics might be my opinion. Now, maybe that's not earnings growth, but they did become profitable. And then once they hit profitability and the market saw what niche they were in, what industry sector, underwater robotics, Kraken Robotics absolutely took off, right? Another one might be Zoomed. Can Zoom continue to go up as long as it continues to have good earnings growth? I think the question for a lot of people right now with Zoomed, is it one of those 5% or less of companies that can continue succeeding? Or is it going to be one of those companies that drops 50% and doesn't come back? So here is the thing, is that sales growth is earnings growth. So sales growth and margin growth is what causes earnings growth. Margins can also only grow so far. Like, it's rare. You're not getting a company that's going to go from like 1% margins to 99% margins over the next few decades, and you're just going to make an absolute fortune. It typically does not work that way. Margin growth is limited. You might get a company that goes from 20% margins to 30% margins. And because of that, those margins are creating much more earnings growth. And because of the earnings growth, this company absolutely goes to the moon. Perfect. So what does it come down to? Again, this is one of the things that I always agree with Ryan Telford on: sales growth. The one thing where the sky is the limit is sales growth. So if you're looking at a company, not for the short term, not for the short-term discovery, right? Not for the short-term pop-up in share price as the market discovers it, not for the short-term earnings growth or margin growth that might last, 2, 3, 4 quarters, where they've restructured the company and they're going to expand their margins. What we're looking for, I hate to say it, it always comes down to one of the least appreciated things in the stock market, which is sales growth. If you can find a company that gets sales growth for the next decade, that is the company that I would rather invest in versus a short-term company which is expanding their margins, because that can only last, like Ian Castle said, 1 to 4 quarters. Getting really good earnings growth. Again, how are they getting the earnings growth? Margins, which are usually only expanding 1 to 4 quarters, and sales growth. What if the sales growth stops? I believe that most investors do not do enough research in sales growth. So I love this. This is like all of this presentation has been scary, and then Ryan Telford gives us hope. So when you look at this pie graph, and again, I say this all the time, as I always start here, whenever I talk about this graph, this is where it starts. This is what we're looking for, is sales growth. When will that sales growth stop? How long is that sales growth going to continue for? If you think it's only going to last for a couple quarters, it's a trade. If you think it's going to last for a year or two, it's probably still a trade. If you think the sales growth can continue for a decade or two, then that's kind of a longer term investable company. Then we get into profit margin growth. So we want to see that margin growth. Why do we want to see that margin growth? Because that's how you get earnings growth. So if you can get sales growth and it's profitable, holding margins or improving margins, this is fantastic. This is exactly what we want. Now, again, profit margin growth usually can't last forever. But I mean, in the eyes of a retail investor, if they can get margin expansion for 1 or 2 years, that'll get it what? Discovered. That's when you get that multiple expansion growth. So then multiple valuation goes up, right? People are willing to pay more for the stock. And that's when you can reevaluate as to whether or not you want to become a short-term trader and you decided you want to sell, valuation is too high, or whether you want to say, hey, no, this is still a good company. They're still getting sales growth. They're still getting maybe a bit of margin growth, or at least holding their margins. And yes, they're valued properly, but they're going to continue to get sales growth. I like it. I'm going to keep it. right? So to me, this helps get rid of that fear of microcap investing, because there is a way out of that. So the difference here, though, I love this post, this is interesting, is that we have to watch it. So I have this complicated slide talking about evaluating the inputs and evaluating the thesis and making decisions. And this is Ian Castle's answer to my slide, is basically saying it's the same difference as children to adults, right? The adults being the mega cap stocks, the large stocks that are going to continue to succeed. They have the capital, they have the resources, they have the time, right? But with microcap stocks, you cannot leave the young kids at home for very long unattended, or they will burn your house down. So make sure to reevaluate, reevaluate, reevaluate. Don't get stuck in that, oh, I'm buying it forever. You need to be able to watch these stocks and pick the timing. You need to be able to pick the timing. Again, one of the best ways to scare you is a chart like Symmetrix, where people have either made an absolute fortune on this stock or they've lost an absolute fortune on this stock. That's it for timing. I loved it. Thank you to Ian Castle for all these different posts, basically starting off by scaring us. And again, I'm going to start showing this more often because this is so important to me, right? It just shows how even large investors are looking for that shorter term price discovery, multiple expansion, margin expansion that can't last forever. They're looking for that shorter term catalyst to get them over the hump. But then, 95% of the time they fall 50% plus, and only 5% of those winners will continue to succeed. This is, so important, where basically what this is saying, 10 stocks could end up, going up. 9 of those stocks are going to go down, right? And then maybe 1 might go back up. And those are the types of odds that we're playing with. But again, for me, it's shifting that short-term mentality here, changing your perception, being a trader, looking for those shorter term opportunities and catalysts, make your money. But if you want to keep the stock, if you think it can continue to go up, make sure you do that deeper research, right? Industry, product, service, competition management, and all that other stuff. I think it's a common misconception that a lot of investors research all of this right at the start. Some people do, institutions do, but I don't think a lot of retail investors do. I think a lot of retail investors are looking for that shorter opportunity catalyst, right? And then they just get out of the stock. And then we have the opportunity, or different investors have the opportunity, to get in with that deeper research, that deeper understanding, these old companies that we've known a while, and rebuy positions waiting for them to go up. So for me, that is it. That is timing of microcap stocks, and thank you for watching. I have one statement. Learning this lesson from McCoy Global, looks like they're only going to have one good quarter this year. Absolutely. And this is the type of company, if we go to McCoy Global, where I completely agree, right? So this can be used as another example. If I move this off of here and I zoom in here, you keep in mind, where's the 5-year chart? This company is improving, and they have opportunities for large contracts in 2026 and 2027, right? This is really the opportunity here. Now, I think a lot of the people that got in short term, got this catalyst here, which is there's smart TR systems being announced. It shot up, right? Or the investing conferences, where McCoy Global is pretty popular. There are people trading around these types of positions. There are people trading this stock around the investor conferences, knowing that McCoy Global typically has a good showing, right? There are people trading around the press releases of this company, where they have a good press release, the market gets excited for a while. I could buy it today. It's probably going to go up in the next week. It does. But then people, obviously, as you could tell from this chart, they get out and they sell. And then we just see this decline here, right? So again, if you bought anywhere along here, you made money. If you bought here, you're just starting to lose money. If you bought here, you've now lost, because it was what, $4, and what was the 52? $4.48, and it's now $3. So you've lost, $1.40. The question now becomes, is it going to be one of those 95% of companies that doesn't continue to succeed and it fails? Or is it going to be one of those 5% or less of companies that actually does succeed in the future? I would argue, based on at least the recent history since 2022, it has been going up pretty steady. It just happened to get above its skis a little bit there, which is exactly what Ian Castle talked about, with a little bit of excessive valuation exceeding its market value. Has done that now twice. But I'd say overall, steady Eddie, right? And hopefully that continues for 2026 and 2027, but it might not necessarily look like that, right? It usually looks like that. So again, with market timing, that's where it's so important, coming back to these old ideas and being able to build that baseline where you think, yes, this is where I think the valuation of the company is. And if it goes up too high, like here, I might decide to trim a few shares and lock in some profits. And if it goes down too low down here, then I might want to buy a few shares because I think it's undervalued. And you might, and this is the interesting part where so many investors, including myself, can be both a trader and a long-term investor at the same time, because usually for me, I never own like 100% position and I never own a 0% position. Very rarely I just sell 100%, right? I tend to buy and sell slowly. So when I get a stock like this and it's going like this, my goal personally, myself, is I try to buy on these little dips. I just add. I continue to evaluate the company continues to succeed. I think it's worth this amount. So whenever it goes below this amount, I tend to buy, and I'll build a position. I'll have 1% position, 2% position, 3%, I'll build up over time. But then I don't necessarily just sit here and say, I'm going to hold forever. Basically, if it goes well above where I think the valuation is for a company like this, I will trim. And I will take some of those profits and I will go buy a different stock to give my portfolio a little bit more diversity, right? Sometimes I've trimmed up here and share price crashes so quickly that instead of buying another stock and building up a bit more diversity, I'm actually just buying the same stock just at a cheaper price. So I sold at the top, I'm buying at the bottom. But I've never actually sold. I've never sold 100%. It's just the same company in my portfolio might range from somewhere from 1% of my portfolio to 8% of my portfolio. Depending where along the line it is, I might be both an investor of this stock holding long term and a trader of this stock who is, selling the peaks and buying the dips. You could do both. And so McCoy Global, yes, it's been another good learning example for sure. So thank you for your time, everybody who's watched this. Really appreciate it. I hope that helps. I hope that wasn't too much rambling, too much talking. But I love those posts from Ian Castle. I love expanding on those posts from Ian Castle and giving my opinion. And I love how he creates that fear, and then I try to pull you out of that fear, right? So that's what I do. Again, not financial advice, but be aware of market timing. Be aware of whether you're an investor or a trader. Be aware that, even if you're going to trade, that means researching some type of valuation, what you think a company is worth, and be aware that, buying and selling at the right time can really bring in some alpha for you as a retail investor as you build experience and as you do it properly, right? So thank you for your time, and hopefully I'll be making another live stream on topics like this soon. You've been watching Common Sense Investing. We will see you soon.